Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending October 24th, 2025. And I'm host Justin Klein. And I am titling this video, Trade Talks Bring New Highs While Liquidity is Drying Up. That pretty much sums it up here. We have a big meeting coming up between President Trump and President Xi this week. We have the Fed meeting, which they're going to cut. Let's go over here. There's a 98% chance they will cut 25 basis points. And, I think the big story more is what happens to QT. Do they wind that down soon or do they wait a little bit longer? And I'll show you from liquidity standpoint that tells you that, maybe they'll do it sooner rather than later. But I'll start off with just kind of what the market did this week. From a heat map perspective, I always like this, kind of gives you a big picture view of what sectors did well and which ones didn't. Obviously, utilities didn't do well. It's certainly a risk on environment with big tech continuing to do well. Outside of Oracle, Netflix, they had earnings and they weren't as good. Same with Texas Instruments. We are in the midst of earnings season, and we also have next week a ton of the Mag 7 reporting. I can't remember which ones, but it's 4, 5, 6 of the big ones. And certainly that reaction there will have a large impact on the market as a whole. What happens with their AI spend, all of that will be really the talk for next week. So really a lot that could happen that could be a catalyst for, I think, a continued strength, but also weakness. And we go into this week with strength, right, on new highs. And I think that sets up for a potential disappointment. And once again, I'll show you on the liquidity side why that might be. Now, I want to show you this too, the finance side. Look at finance. Look how green it is pretty much across the board. All different types of companies, from the investment banks like Goldman Sachs to your traditional banks like a Bank of America, your credit card processors like Visa and MasterCard. But you saw weakness out of Blackstone and BlackRock. So, they're tied to private equity, private credit, etc. And I think that's certainly something of note. But we'll dig into the economic data real quick. U.S. existing home sales did tick up a little bit, so lower rates are helping the housing market just a little bit. Still, as I've said before, I think we're going to stay kind of between this, 3.9 million and 4.2 million homes sold for an extended period of time. A lot of real estate agents are going to struggle because simply volume is drying up, and it will remain dry, I think, for a number of years because people are just locked into their 3% mortgages and they don't want to sell. The Kansas City Fed Manufacturing Production Index, that did tick up. That was some nice strength, good positive there. CPI, remember they were in the midst of a government shutdown, so some of the data that should have come out this week still is not. Things like unemployment claims, continuing claims, etc. Consumer Price Index, that did finally come out. I believe it was delayed, if I remember correctly, and it came in better than expected. So 3.01, still a tick up from September, but the core actually ticked down from September. Still, we're around 3%, not at the Fed's target, but the Fed will be cutting rates coming up. So that's quite perplexing a little bit, but they're trying to balance those risks. Consumer sentiment did tick down again to 53.6. So obviously the consumer is not feeling great about the jobs market, about inflation, etc. And this is where we get into liquidity, because as I tell this video, liquidity continues to not look so hot. So this is the SOFR, secured overnight financing rate. This is what banks are lending at between each other, and this continues to tick up. And we're at levels 4.25. This usually should be right around what the Fed funds rate is. And you can see here, back when the Fed funds rate was, let's go here. Okay. The Fed funds rate, let me go to the effective funds rate. There we go. So here, effective funds rate was 4.33. That's where it was for a long period of time. And you could see it bounced around that level, 4.31, 4.33, maybe it ticked up to 4.39, and we did tick up all the way to 4.51 before that Fed rate cuts. And you can see as that was rising, when this goes up, it means that there is a level of reserves there's not enough reserves in the system effectively. And you can see that here. There we go. Usually, a lot of people think 3 trillion is the amount that's not enough. Okay, and look at a 1-year chart, and you can see this has been on decline. Now we're below 3 trillion. So you're seeing reserves being drained from the system, and that is why you're also seeing the effective funds rate go from 4.09 to 4.11. Now, that doesn't sound like a lot, but remember, if you go back here, look at this chart. Look how this is straight across 4.33. Did not tick up. There was no volatility. Only time it was back in 2023, it actually ticked down a little bit, 5.08 to 5.07, then back. But that's because there was too much liquidity in the system. Okay, now there's not enough. And what that means is there's not enough liquidity to kind of buffer a negative market shock, like poor earnings, like trade war, like a Fed that maybe isn't as dovish as the market had hoped, etc. So that's why I think we're setting up where there's optimism around trade, there's optimism around earnings and the AI, there's optimism around the Fed being super dovish, and you can see that here with what they expect rates to be for at the end of the year, right? 2 rate cuts, and then you go even all the way out to June. You have this going to basically 4 rate cuts between now and March. No, is this April? Yeah, March. This is basically saying their modal outcome is 4 straight rate cuts in the next 4 meetings. Pretty interesting, right? 3 to 4, excuse me, 3 to 4. So I think there's just a lot of optimism around the market, and it sets up for a disappointment based on lower liquidity. Okay. Now, what's positive here is banks are lending a little bit more. Bank growth is still solid. That's good. You have this is negative though. Treasury General Account rising to 908. It's reserves being drawn from the system. You can see this with here, right? So this is July. It's at 3.35. And what did we do here? This was July, right? So when this goes up, this is draining reserves from the system. Okay. This is draining reserves from the system. And that is a negative. Okay. That is a negative for the market. And like I said, that's dry tinder for a potential sell off. And then the canary in the coal mine is actually Bitcoin. So Bitcoin is not getting off the mat here. Okay, this is the monthly chart, peaked out at what is this, 126 recently, back in early October, and once again failed to break out. So it's been about a month and a half now, or not, I guess not a month, excuse me, 3 weeks now, where it's sold off and it's just been kind of chopping sideways, bearish consolidation. If this breaks the 100,000 mark, that's a clear indication that liquidity is on its last leg, and that's what worries me about where we are setting up going into this week. Now, am I saying that we're going to enter a bear market or anything like that? No. What I am saying is it's going to become a little more difficult to find headway in the market. I think we're entering a more choppy period because of the lack of liquidity. However, a lot can change what the Fed does. How dovish do they really get? Right? They're cutting rates. They're talking about ending QT. Are they going to do anything else to fix things like Zion Bancorp? Right? That's bounced back pretty fine. Western Alliance, that bounced back pretty fine. So this is the question. that we have to kind of battle with is, yes, liquidity is drying up. The Fed clearly sees that. That's why they're going to cut rates. That's why they're going to end QT soon. It's just a matter of, is it going to be enough? And at what point does it start to manifest in more volatility in markets? And once again, I always say the canary in the coal mine is Bitcoin. It's hanging in there, and that means liquidity is hanging in there because banks are lending, but it's something to be on watch for. And I do think Bitcoin probably is top for this recent cycle. We shall see. Could certainly make new highs, with especially if a dovish Fed coming up. But that's kind of how we set up going into this week. Now, let me get to some more of these charts. Okay, here's the VIX. VIX, we didn't break those recent lows, so that's of note. And then you have, here's the VIX EQ. So this is the actual individual constituents of the S&P 500. What you can see here is, oops, this is pulled back, but it's still an uptrend. Okay, this was kind of that initial canary in the coal mine of, hey, volatility is going to start, and that was this day, or the 10th, or no, the 10th. That was when Trump tweeted, and we had that big sell-off in markets. Now we bounced back, and so far, if you go to like the Nasdaq, this is now closed above. So this bearish, micro bearish pattern has been negated, and that can happen, right? Especially when the trend is your friend, and it's hard to break that trend. And we didn't break the 50-day moving average. We didn't break anything that tells you, okay, we're gonna have a deeper pullback. So not shocked to see this. It was just more of a micro pattern that could bring us into more of a shorter term downtrend, but we're not, quite there yet. The move index, that one's fine as well. It's another one where no real issue. This is the one where I would be more worried about the market if this was rising. It's not. Everything's fine on that front. Let's go to the PSP because that kind of gives you a broad view of it. But this is the global private equity funds. Obviously, those are early indicators that there's problems with funding and problems with liquidity. But it's kind of held that 200-day moving average. So far, it's okay. Even if you look at things like the bigger private equity names like Apollo, obviously Apollo's very weak. It's a micro bear pattern here. You have Blackstone, same kind of thing, very weak. KKR, I think this one, yeah, another one that's very weak. So kind of the bigger names are certainly struggling in a material way. Let's get to gold. So gold had a volatile week. There we go. So gold pulled back. It had a pretty large drop, but just found support right at that 50-day moving average. So as I said, I think we're entering a period that's similar to this, where there was a cover of Barron's talking about gold in April, and I said sentiment got a little too hot, and this probably needs to cool off a little bit, and probably going to bring some level of consolidation, pullback pattern, corrective period. And this is a perfect example where charts or price of any asset can correct in two ways. It can correct in price or time, or both. This corrected in time. It just went pretty much sideways for 1, 2, 3, 4, 5 months before it broke out. Do we get the same type of thing, right? Chopping around this 4,000 mark on gold price for a number of months before another leg higher. I think that's certainly possible. Do we get a pullback to the 100-day moving average? That's possible as well. But clearly the background fundamentals of why gold prices are going up have not changed. Geopolitical situation has not changed. Okay. And here's GDX. Nice little pullback here. Same type of thing, right to that 50-day moving average. No issues with it. Initial support area could go down to 65, would not shock me. and I said this, I think it was on Monday, that if you're going to invest in gold, be prepared. Be prepared for volatility, because these will have very sharp, very quick, very sudden 10, 15, 20, 25% drops in price. Look at this, peaked out at it's 85. Dropping to 65, that's a pretty hefty move. 20 points on the GDX. You're talking about 25% drop in this name in a very short period of time. And so when you're playing in this space, you have to understand that risk. Okay. EFA to the IWV, this is a foreign stocks to domestic. Just kind of consolidating. Real no issue. This is one of those ones where it corrected in price. Now it's kind of correcting in time. I do think it will resolve higher. But so far, recently at least, foreign stocks and domestic stocks are kind of performing equally as well. Let's look at growth to value. So growth had a nice little resurgence the last couple of days, but not really making new highs or anything like that. Remember, the leadership in this market is in tech, is in the growth side of the market. Here's XLK. And while it had a nice little move, other parts of the market, at least since earlier this month, are doing better. Okay. So something of note, I think this is a very interesting chart to see where leadership is. I think when this does roll over, that will kind of spell a risk-off environment. It'll become with a risk-off environment, most likely. Okay. What else do I want to get to? KRE, the banking index, nice little bounce this week, but once again, regional banks, just not a great place to be. KKR, KKR. We looked at KKR. Anything else? Home builders, ITB, that remains on the weaker side. Let's go with currencies. Look at the UUP. There it is, UP. So the dollar, it's been getting some traction to the upside, but I still think it's in a structural downtrend. The yen is always something to watch out for. Does this get another resurgence higher? And honestly, I think this is another reason why equity markets are hanging in there, despite liquidity drying up. Is I think the yen carry trade is picking up steam with this weaker yen. So I'll be watching that to see if that's sustained or has some sort of reversal. That's always kind of on the back burner of potential risks in markets. So with that said, I'll probably leave you with just a simple explanation of where we're at. We are entering, let's go to the S&P. We are entering this week at new highs with a lot of optimism, a lot of divergence here on the MACD. Just saying this is not a new high to trust. And then I'm looking at the liquidity dynamics and I'm saying, you know what? I don't really feel comfortable. I don't feel excited about chasing these highs. I look at Bitcoin and it's not getting up off the mat. And I look at once again, the optimism around earnings, optimism around the trade war, optimism around a dovish Fed. All of that means I feel like it's kind of like buy the rumor, sell the news type of event. That's what my experience is telling me. I could be wrong. My experience tells me I could be wrong. But you listen to the gut, listen to your experience, listen to the data, and it kind of lights up for, I think, a week that is set for disappointment. But we'll check in next week, see if I'm right or wrong. Appreciate you all tuning in, liking and subscribing to this channel and our podcast, InvestTalk. Reminder that at the comments and ideas in this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.